Hi everyone and welcome back to the channel. So I've decided to put together a series of videos for first timers or beginners to investing, and as the videos progress they will become more and more in depth and detailed. However, starting off today we'll start at the very top level and then advance accordingly. So with today's video to start with, we'll look at what is investing in general. We will then move on and look at different types of investments that you could possibly make. We will then move on to the stock market and how that works, because the stock market in general will be the main theme of these videos. And then we will look at the expected returns you could make from the stock market. Just before we move on then, if you could leave a comment and subscribe to the channel, that would be great. And then you can stay up to date with all the future videos. Likewise, I do have an Instagram page as well, dedicated to the same theme as this channel. As you can see here, we just surpassed 1,200 followers, which is great, and that increases by about 100 followers per week at the moment, which is fantastic. And I really appreciate all the support there. So if you want to go ahead and follow that as well, you'll be able to receive pretty much daily updates either on my portfolio itself and how that's progressing. It's currently around £32,000 and growing. And then I also provide daily educational points as well on investing in general. Okay, let's get started then with the first point in today's video. What is an investment? An investment or investing is a long way from putting your cash in a bank account where it sits to earn interest. An investment is essentially a gamble. Instead of the security of guaranteed returns, you're taking a risk with your money. The hope is that you will make a lot more than you put in, a juicy profit, but there's a possibility you end up with less, a nasty loss. You can invest in almost anything from the most mainstream popular targets, shares, bonds, funds, government bonds, the property market, for example, many different options. Or you might prefer to go for something a little bit more exotic, such as farmland, vintage cars, wine, art. There's many different options. For the most part though, investing means putting money in the stock market. This series of videos is first and foremost about investing in stock markets. It's most people's first experience of investing. And putting your cash into these markets is exactly what it says on the tin. You buy shares in one or more companies with the aim of making a profit. And although there are different ways to do it, such as funds, which we'll talk about in later videos, the principle of investing remains the same. You're taking a gamble with your money, as there's no guarantee you'll get it back. In the worst case scenario, you could lose it all. And I think this message is very important and worth repeating. Investing in stock markets is a gamble. While you could win small or win big, you could also lose small or lose big and end up empty-handed altogether. So the risk is definitely there, and it's vital that you are aware of this, especially if you are new to the world of investing. While the concept of stock markets may trigger images of young brokers yelling buy, sell, heads and hands 1 minute and fist pumping the next, the reality of long-term investing tends to be rather more mundane. Pick a few shares or funds, keep an eye on them, and then cash them in when you need to. This is not the racy, glamorous, or high adrenaline action you see in Hollywood films where fortunes are made and lost in minutes. It's certainly not the Wolf of Wall Street for everyone. For the vast majority, it's about nurturing a reasonable and calm attitude to the stock market in a bid to generate decent investment returns that can weather downturns and ride out wild surges in the markets. Moving on to the second point of this video then, how does the stock market work? To keep it as simple as possible, and for the purposes of this video series, a stock market is simply a place where buyers and sellers meet to sell shares, each one a tiny part of a company listed on an exchange, which again we'll talk about in later videos. Why do shares exist in the first place? To grow and hopefully boost profits to turn a business into a financial success. Firms offer investors the chance to back them with their own cash. Enter a stock market. In return for your cash, a business offers you a share in its future. So here's me as an investor handing over my money essentially, and in return, that company or business will provide me with a small share of the overall business. Hence, I have now become a shareholder in that particular business. And if I wish, this slice of the company that I own can be traded with anyone else who wants to buy it from me in the future. Again, that is done via the stock market. So why does a company's share price rise and fall? The price is initially set by the firm offering shares, an IPO, which we will discuss in future videos. The company's share price on any given day can be determined by many different factors. However, the two principal factors are the performance of the company that has issued the shares and then the wider environment. So poor financial results will have a negative impact. A country's economic health as well will also have a big impact. And so-called sentiment. If city buyers think a firm will struggle, its price can fall. Or if a company doubles its growth in a year and prospects look very rosy, then the price will likely rise. So in simple terms, this is what factors will be impacting on the share price of a given company on the stock market. So what return can you expect from investing in the stock market? This is usually the question that most investors want an answer to, and the very reason behind most people's decision to put their cash into the stock market. I'll be blunt, we can't actually tell you an exact figure, but this will give you an idea of what can be achieved. With savings rates hovering around historic low levels of 1.3% on a typical competitive savings account, the incentive to look elsewhere for decent returns is strong. Over nearly the last century, the stock market's average annual return is about 10%, but year-to-year returns are rarely average. Keep in mind, the market's long-term average of 10% is only the headline rate. That rate is reduced by inflation. Currently, investors can expect to lose purchasing power of 2% to 3% every year due to inflation alone. It is still significantly better than putting your money into a standard savings account though, in my opinion. I would still rather be looking at maybe 5, 6, 7% increase annually than the 1.3% average that you will get with a standard savings account. Just one more important message for you all before I finish off the conclusion. Investing is risky and any money you put in could fall in value. You could lose it all, essentially. Past performance is no indicator of future success. You have no guarantee at all your investment is going to do well. That's not to put anyone off, it's just to re-emphasize the risk involved. And it's really, really important to educate yourself before getting involved with investing, or if you're still at the early stages of investing in general. Well, that brings me to the end of part 1 of this series. Hopefully you found the video interesting and educational. In terms of looking forward to part 2 of the series, we'll look at is investing right for you. We'll also look at how much you should invest. And then we will look at how do you start investing in general. So hopefully part 2 will also be very interesting and you can continue along this series with me. Please subscribe to the channel if you haven't done so already to make sure you are up to date as to when that video comes out. Here are a few other videos in my channel that you may want to go ahead and check out. And thank you very much for watching. I look forward to speaking with you all again very soon.